Okay, thank you. So again, I am with Prince George's Community Federal Credit Union. Our credit union has helped to anybody that lives, works, worships, or volunteers in Prince George's County eligible for membership. So I'm also on the board of FSC First, and I have my bachelor's degree from Bowie State University in '98 and my MBA from the Basson College in Wellesley, Mass. in entrepreneurship. And I've got about 22 years in commercial lending and banking experience. So just give you a little bit of background about me. All right, next slide, please. Now, why this workshop matters. A lot of good businesses are declined for avoidable reasons. Lenders focus on facts, not effort. Preparation leads to better approval and better terms. So let me just take a step back here. A lot of people have great ideas for the business, but they don't have all their ducks in a row. So one of the reasons we have this workshop is to help educate you about how lenders look at business applications for credit. Lenders are supposed to be non-emotional. We're supposed to just focus on the facts, and keep all the ancillary things to the side. So the more prepared you are when you go to meet a lender, whether it's a bank, credit union, or a CDFI like FSC First, you want to make sure that you have all your ducks in a row, all your paperwork together, because that's going to save you time, it's going to save the banker time, and it's going to be able to create an environment that creates that banker to be your advocate for you. They're the ones that have to sell the deal to the underwriters. So the more they know about you, the more comfortable they feel about you, it's going to make it an easier process to get that loan or a line of credit approved for you. Next slide, please. Now, what's in this session and what's not? So we really wanted this session to be educational and practical based on real credit decisions that I've been part of, and I can speak to it. But we're not tax advisors. We don't give out legal advice. And of course, this isn't a guarantee you'll get an approval, because every lending institution has their own policies when it comes to credit. But as long as you get a fundamental understanding of tonight, and that's what we're hoping to give you, I think you'll be in a better place than you were before this class. Next slide, please. Well, what we're going to really spend a lot of time is really, how do lenders evaluate your cash flow? And what I mean by the cash flow is how you make money and how much money you keep. How we look at tax returns, how we talk about how collateral will make a loan work, some common red flags, and then how do we prepare before applying? Next slide, please. Now, when a lender asks for a financial package, there's a couple of things that they really go into that. They're looking for the application. They're looking for the tax returns, typically 2 to 3 years, personal and business. They're going to look for a balance sheet and a profit and loss, typically a month prior to the year end, or if you're close to the year end, whether it's physical or calendar. Or they may say, like, if I'm looking at a deal right now, I'd want the year-end 12/31s. And what I mean by balance sheet is what your assets and your liabilities were as of a certain date, like a snapshot, a picture, and an income statement just shows your revenue for that period. Once we get that, then we do a financial review. We look at the assets, we look at the liabilities, what the credit risk is. We look at your individual risk analysis. So that's really important. You know what type of industry that you're in. Typically, a restaurant is going to be a lot harder to lend to because they're in a high-risk industry, especially with COVID. Coming out of COVID, there's lots of restaurants that failed. But if you have like an accounting practice or, a doctor's office where you got a good book of business, that's a lot easier to approve from a risk perspective. And then you have the credit decision, whether it's an approval, a counteroffer, or a decline. Typically, those are going to be the three. We get into the 5 C's of credit. Now, this is where we're going to spend some time at. A lot of people say, okay, what's really important, Steve? when it comes to this. And, the real thing you want to look at is what your individual situation is. So when we talk about character, now this is going to be your credit history, your payment history, a length of time with your banking relationships. We want to look at your resume, depending on the amount of the loan request. How much experience you've had with that industry, or that your team that you're putting together has for that industry. We look a lot at, how have you repaid? Are there some blemishes on the credit report? Because they're usually going to pull from different bureaus. So we for the credit union, we pull from Equifax, excuse me. They could also look at Experian. They could also look at Dun & Bradstreet. They could look at for the business side, and then TransUnion again. Your personal score is going to have a lot to do with this. A lot of people think they can just get a loan. They don't have to personally guarantee. But on business loans, typically 99% of the time, unless you're over 10 million in revenue, you're going to be personally guaranteeing that loan or that line of credit. So they're going to look at your personal history the hardest when it comes to deciding, do you meet the minimum requirements for the loan to get approved? Because a lot of financial institutions, they have a floor that they won't go below like 685. That's like M&T. Truist is like that, I believe. For us, 680. FNC First will look at lower credit scores, if the deal looks right, but it's really telling the story. So here's an important thing to talk about right now. If you've got a red flag on your credit, you want to make sure you disclose that to the lender up front, because they will find out when they pull your credit. And it's not a great conversation to have if you've got an active bankruptcy and you didn't disclose that to the lender up front, or if you've got tax liens or a collection account. But you want to be as transparent as possible to really, have that person, that banker, be able to advocate for you. So you want to address any type of red flags up front. The second one that we look at is capacity. Now, this is one of the most important ones because this is your ability to repay. So when you have a cash flow issue, and we'll get into this a little bit later on debt service coverage ratios, but the business has to have enough money to pay the debts that you currently have plus the debts you want to have. So it's really important, especially when we see tax time right now, when you're talking to your accountants, your bookkeepers, you want to make sure that you're showing net revenue and not taking losses in the business, if at all possible. Because what happens is you come to a lender and you got negative net profit, and you say, okay, well, this was a bad year. I've got 2 other years of good profit, and I can explain it. Okay, that's a conversation. But if you got year after year of losses, it's going to be very difficult for you to get traditional lending when you don't have the income. And again, that's really going to reflect on your tax returns, showing a net profit. And then what also people don't understand is if you're showing net profit from a business, that will also help you on the personal side. Because if you go for an auto loan, a mortgage, a personal loan, they're going to look at, what revenue sources you have. If you're reporting under Schedule C, any net profit, that's going to get added into your income. So capacity is really, really important, probably one of the most important out of the 5 Cs. And it's something that we always want to see the business be able to service the debt. Now, in some cases, if the story's good and you've got other income sources coming in, like say you got a full-time job or you got another business, lenders can look at what they call the global cash flow. And the global cash flow is all other income streams coming in. Maybe the business can't service the debt, but the global cash flow can. So then they can make the deal work that way. But most lenders really want to see the business be able to support the debt. The third C would be capital. What capital is how much investment you have put into the business. Lenders want to see that you've got a skin in the game. They want to see that you have commitment. Typically, lenders don't want to refinance credit card debt that you've personally put into the business. They want to see business debt and that you paid into, you've got capital in there. Retained earnings is a big thing. If you got negative retained earnings, That's a big warning sign. They look at the owner's equity. They look at, how much you're putting down on the equipment or the vehicle loan. Most lenders like to see 10 to 20% down. If you're doing a commercial real estate, typically 25 to 30% down, unless you're doing owner occupied. And then you could look at a SBA 504, which FSC First specializes in. And, definitely if you have any more questions about that, we can have Stuart Smith or Jasmine Forbes reach out to you and explain how a 504 works, because you only have to put 10% down on that. So capital, again, how much money are you putting in? How we look at that is we look at the balance sheet and we see how much equity you have, how much money you've put in. Is there notes for shareholders, or does the company lend you money? So there's a couple things that could work there. We really just want to make sure you're not over leveraging the business. Again, negative equity is a big red flag. The fourth one is collateral. Collateral can be challenging sometimes. For a line of credit, typically you don't have collateral, or what the lender will do is they'll do what's called an all asset lien, a UCC filing for all business assets, but that doesn't really mean much. Some look at your accounts receivable as far as a line of credit goes for capital. Your receivables would be collateral there. For a vehicle, it's typically the vehicle itself. The VIN number will be in the loan documents, because that'll be the collateral. If you're buying a building, of course, just like on the personal side, you want to have the building as collateral. If there is this collateral shortfall, there are certain programs out there that FSC First can work with you on through the SBA, either a 7A, the 504 program. And they've got about 14, 15 other different programs that they can look at for you to see if they can get the loan approved for you, or the line of credit approved for you. Because as lenders, we try to make good loans. And, one thing with my credit union is, if we can't help you, we'll try to find somebody who can. And it's really good to have a team of people, a banker, an insurance person, an accountant, and a lawyer. Have a team that can support you through the thick and thin and really help you grow and scale your business the right way. The last one is going to be conditions. Now, conditions is something you want to look at, what kind of climate you're in, with post-COVID. Do you have supply chain issues with the tariffs? How are you going to use the loan? And so you want to be very specific in the loan request. Just don't put working capital. Spell it out exactly what you're going to use it for. It's going to add a lot of credibility to you with the lender. So, if you say a line of credit for $50,000, okay, I'm going to use $10,000 for payroll. I'm going to use another $15,000 for marketing expense, $15,000 to build up my inventory, and I want to have $10,000 as a reserve. That's a lot better than saying I want a $50,000 working line of credit. When we get to conditions 2, you want to read the loan note or the line note. You want to understand what your rate of interest will be charged when the first payment is due. Is there a prepayment penalty? Are there certain restrictions, or what they call covenants, on the loan agreement, saying that you have to maintain a certain debt service coverage ratio, or that you need to keep all your funds in one bank, or that you cannot refinance with another institution for a set amount of years? It just depends on the type of lending facility, but you always want to read the loan note, because once you sign it, you're committed. So the bad questions are the ones you don't ask, because you want to make sure that you understand, hey, is this something that I need? Is this something that's going to be effective for me? Because again, once you sign that, you're dedicated that for the term of that facility. Can I get the next slide, please? Now, let's go back to capacity. Capacity, cash flow repays the loans, collateral reduces the risk, and tax returns validate the story. So when we're talking again cash flow, you got your revenues coming in, you pay out your vendors, you pay out your employees, you pay your taxes, and then you got the net profit, and it starts all over again. If you're a relationship business, you've got repeat customers. If you're a transaction business, you got to keep finding that next customer, that next customer, that next customer. When we look at collateral, that really reduces the financial institution's risk because you have what's called a secondary repayment source. So the first repayment source would be cash flow from operations. The second one would be liquidation of collateral. And then when we talk about your tax returns, this is why, going back to what I said originally, you want to show as much net profit as possible so that, yes, you'll pay more taxes on it, but it's going to give you the ability to lend and to borrow more money from lenders because you show that you have enough to pay your current debt plus the future debt that you want to acquire. So it's really, really important that you keep that net profit in mind when you're coming in a meeting with your accountant when you're closing the books for 25 and you're looking at 2026. Next slide, please. So getting down into what cash flow is, again, money coming in versus money going out, understanding the difference from profit versus gross sales, and that money is going to determine your repayment ability. So what's really important, and this is something I talk to my members about, is understanding your cost structure. What is your fixed cost every month? That's if you sell anything or do any services. If you don't do anything at all, you still have fixed costs, your insurance, premiums, your lease notes, your internet cable bill, and then you have your variable costs. That's your per widget or per service, and then what you sell your services for. The middle part, the subtraction of that is your net profit. So if you understand what your net profit is, then you can start forecasting out, okay, Steve, I cut hair and I make a net of $100 per hair appointment and it takes me 2 hours and I do 3 sessions a day. So that's $300. Okay. So then we can say, okay, well, you make $1,500 a week. That's $6,000 per month. How does that impact your budget, your revenue? And those are all individual questions, but this is how the lender starts to think. Next slide, please. Why cash flow matters most. It's what pays you back when the lender looks at it. Okay, how am I going to be repaid? Consistent cash flow shows stability. Stability makes underwriters feel happy that you've got recurring business, that you've demonstrated that you can manage your business. And that's why typically lenders want 2 to 3 years in tax returns, because they look at year versus year trend comparisons. How'd you do in 2023? How'd you do in 2024 versus how'd you do in 2025? Now we know 23, we were still dealing with some COVID issues, so there's some explainables about that. But definitely something you want to look at. Also the risk level. If you've got cash flow that's up and down and you're not in a cyclical business like a ice cream stand or, something that's seasonal, that's going to raise some red flags with the underwriters. They're going to be like, well, help me get a better understanding of their business model. Is it only certain months of the year that they have business? Is it contracts that are expiring and they're having trouble getting new contracts? So cash flow is really important because it shows us the trends. Next slide, please. Now, what the lenders typically will ask for, and we touched on this a little bit, is the income statement. So that's the profit and loss. The balance sheet, which is just a snapshot in time of what your assets are and what your liabilities are. Cash flow statement, that's really showing, and this is more for the larger businesses, showing where the money's coming from. Is it from operations? Is it from borrowing? Is it from capital injections or investments from outside owners? And then the bank statements. So the bank statements are going to show money coming in, money going out. It could show ACHs, which are electronic payments or electronic deposits. So that can say, okay, we've got documented that these people are getting paid every month. It gives the lender a little bit more leeway. Okay, they've got more cash than they need. I feel more comfortable because they can easily repay us. So these are typically what we're going to ask for. And with this, typically you're going to want to see an application and a personal financial statement, depending on the lender. Next slide, please. Sample income statement, basically ABC Services, last 12 months, revenues were 300,000, cost of goods sold, also known as COGS, was 90,000. Operating expenses was 165,000, so net income was 45,000. That's a very nice number to have when you're talking about net income. And you really want to see that net income as high as possible, because that's going to be able to show that you have the capacity to borrow more and more. And then when we're looking at trends, we're going to look at your trends from, again, 2023, 2024, 2025. What was the gross revenues? What was the net income? Next, please. Again, talking about what we look for, revenue trends. We talked about that a little bit. Expense control. So this is one that we're going to spend a little bit of time on. Expenses. Depreciation is something that you can add back into the cash flow. But most other expenses are going to be expenses that the lenders are going to know, are they one time if they're very large, or is this just a normal cost of doing business? Like if you're a trucking company, we're going to see a pretty large expense on insurance premiums, really large expense on labor. We also will see a large expense in fuel cost and probably maintenance and repair expenses. And, you know, hopefully we've got good depreciation to help offset that. Net income stability. We just want to, again, I can't overemphasize the fact you want to show as much net income as possible in the business, because that's just going to help you. And then owner compensation. How much are you taking out of the business to pay your own bills versus how much are you leaving in to let the company grow? And that goes back to how much skin do you have in the game? Cash flow versus net income. Again, we can add back the depreciation. We can adjust the owner's salary. And we can also, if you give the banker an explanation of some big expenses, we can remove one-time expenses. Because we can say, okay, this is a one-off, it's not reoccurring. Let's say that you had to replace the roof on your building that you owner-occupy on. Well, the roof's going to not probably go out on for you another 25 years. So that's a one-time expense. We can usually take that out of the cash flow, and that's just going to improve your liquidity for that request. Next slide, please. Cash flow example, net income, 45,000. Depreciation, add back 10,000. You had a $5,000 one-time expense. So your adjusted cash flow, when we go to look at it from an underwriting perspective, is that you have $60,000 available to you. And just take a step back there. Net income, very important. Again, depreciation expense, we can add back that in. And then one-time expenses, we can back out if you can show over a period of 3 years that this only happened to you once. And then the adjusted cash flow for the underwriter to look at is saying, well, you really made $60,000 instead of $45,000. That's why it's very important that you have a good accountant that can help maximize your capacity to borrow and to manage your finances as well. Next slide, please. Now, here is one of the most important cash flow ratios is the debt service coverage ratio. And that's the cash flow divided by the total number of annual debt payments. The target's usually 1.2 to 1.30. Honestly, most times 1.25, depending on the type of loan. I've seen some real estate deals, they want 1.4 on there. So let's go for an example here. Let's say that you have about $5,000 annual business debt, and you come in and you say, Steve, I need to buy a car for the business. You know, we've been in business for 3 years, and those monthly payments, if we equal them to a year, is going to be another $5,000. So that's $10,000 annual debt service. So when I talked to the member, I said, well, let me see your tax returns, because the magic number we're looking for is $12,500. That's 1.25 times the $10,000 in debt that you have plus debt that you want to have. And as long as you're over that amount, we're good from a cash flow perspective. So really, really important. And again, overemphasizing this here, but your debt service coverage is so important because this is the ratio that the underwriters look at the most. And if it's close, we can look at global cash flow. Again, that's pretty much the same thing. You look at your debt versus how much income you have annually going in and out. But the business really wants to be able to repay the debt. So if you're going to me, you're going to M&T, you're going to Truist, or you're going to FNC First, that's typically what they're going to want to see is about 1.25 on that. Next slide, please. Okay, so let's talk about what the underwriters don't like to look at. These are red flags. So red flags could be a number of things. The first biggest red flag is declining revenue. And what we do is we typically will take 3 years and we'll look at your gross revenues every year. Now, understanding that COVID impacted a lot of people, understanding that, the government shutdown and the government layoffs have impacted people. We take that into consideration. But if you've got declining revenue every year, that's really going to set off some red flags because it's concerning that you will continue to have losses and the lender might not get repaid. Heavy cash withdrawals, okay? This could impact you by, where is the cash going? Is it going to pay expenses or is it going to pay in your pocket? There's certain things we have to be, as financial institutions, aware of when it comes to anti-money laundering and heavy cash withdrawals, unless it's, something that can be easily explained. You might be in a cash business, okay, but even then, it is something that, it raises a red flag because a lot of banks, unless you go to the real high-level commercial banks, don't like doing business with what they call money services businesses like ATM, people that have ATMs, or they do any type of hard money lending, or they deal with a lot of heavy cash just because there's certain reporting requirements that can cause red flags. Another one is mixed personal expenses. So if you're paying your mortgage out of your business account, the underwriter's going to say that's commingling, and not only you're going to raise a red flag with the underwriter, but you could be subject to the IRS coming in and getting rid of some of your exemptions or expenses that you thought you were going to be able to take off. In my family, my brother had a horse farm, and they disallowed a $16,000 exemption for him because he was commingling. He was making the payments for the vehicle off his personal account instead of his business account. So it's really, really important that you have a separate business account and only do your business from that account, and you keep your personal account and your business account separate. Now, typically, financial institutions would like to see both bank statements because it shows that you have personal reserves, and it verifies when you fill out your personal financial statement that you have the actual assets in there. So, really making sure that you keep your personal accounts in good order and also in your business account there in good order. They also will look at your bank statements and they'll look for overdraft fees, because if you're not handling your account properly, that's a red flag for the lender. So we typically like to understand if you got a lot of overdraft fees, what's going on with that. Another red flag, and this is really, more so towards the lines of credit, but it could also affect other lending, is your dependency on one major customer. So, for example, when I worked at Bank of America, if a person comes in, a business comes in, and we look at their accounts receivable and 80% of their business goes to one person, we're going to discount that receivable really far down and may not even be able to use it. Because what happens if that person or that entity goes out of business or stops doing business with you? That's going to have a major impact on your revenue. We see that now with government contracts. Everybody was great. They had 4 or 5 year deals with U.S. aid, AID, and they pretty much chopped up the agency due to political maneuvering. So it's really important that you diversify your customer base. Is it transactional where you can, just go out and keep getting new persons to buy your product or your service? or is it relationship based? You got repeat business. You can build a book of business. A lot of that's going to go into the underwriter's thought process is, okay, relationship businesses we like better because these are reoccurring businesses. These are people that you constantly do business with. They keep coming back to you for products or services. And that's really how you're going to help your business scale and get more cash flow, because that cash flow is going to allow you to expand and also, take more money out if you need to provide for you and your family. Next slide, please. So why tax returns matter? Well, this is what you file with the federal government. So, unless you're committing tax fraud, and some lenders will request a form that you have to fill out to the IRS to get a copy of your tax return to make sure that that is the correct tax return that you filed. I've had a couple instances over the years where people give me tax returns that don't match. And that is a very awkward conversation. Trust me. Usually it kills the deal very quickly. Tax returns are what we pull to show historical performance. Now, again, 3 years. That's why typically most financial institutions want to see it. They want to see what you reported to the federal government. You can tell us, hey, I made all this money, but if it doesn't show on your tax return, we can't count it. The other thing that we look at is, are you consistently making the same revenues? Is it something that is sustainable in this market? Are you an industry that could be disrupted easily? Next slide, please. Different types of business tax returns. Schedule C is probably the most common. Schedule C, sole proprietorships, and just LLCs that report as a member. You got 1065s, 1120 OSs, 1120. So there's different types of tax returns, but most of the time, and most people on here are going to be looking at a Schedule C. And a Schedule C, it's really easy. It tells everything up front. It starts out with your gross revenues and just goes down, and at the bottom is the net profit. So those are typically the two lines that we look at the most. And then we'll look at your expenses and then say, okay, do you have any depreciation or interest that we can add back in if we're paying off debt? So definitely you're probably going to be dealing with Schedule C in most cases. Next slide, please. Now on the Schedule C, again, gross receipts, you got $250,000. So that's your gross revenues. You got $210,000 in expenses. So that's your taxes. That's your employer, you're paying your employees, you're paying for your goods or services. And then at the end is the net profit. So in our example, we got $250,000 in gross revenue. We got $210,000 in total expenses. We got $40,000 left as the net profit. And that net profit is what we look at when we're looking at the cash flow ratio, the debt service coverage ratio. And that's the one that, when you're talking to myself, you're talking to Stuart, you're talking to Jasmine, those are the people that are really going to, go and, okay, let's look at the net profit. Next slide, please. So here's some common expenses on the Schedule C. Advertising, marketing, vehicle expenses, contract labor, that's your 1099 employees or your virtual employees, rent, utilities, and depreciation. So with advertising, you want to look at, okay, what type of business that you have. Does it make sense to be in that type of, those type of expenses? I had one assisted living nursing company that spent $4,500 in basically 2 months on advertising and only saw 2 leads from that. And we had a conversation like, okay, this isn't working for you. You got all this advertising expense, but it's not producing the revenue that you need to produce. So advertising is definitely one I would look at and saying, okay, is this money being well spent if you see a large amount in advertising? Talk to me about, what kind of return that you're getting when you're spending $30,000 in advertising and your top line revenue is $100,000. Vehicle expenses, that's totally legitimate in most cases. You got to have a vehicle, you got to drive it around. Contract labor, rent. I mean, you gotta own a shop, or you're going to pay somewhere to have a shop open unless you own the building. And if you own the building, then it'd be mortgage due. Utilities, that's pretty common sense. And again, depreciation is one of the ones that you can add back in to the cash flow. Next one, please. How lenders adjust to Schedule C. Okay. Again, we add back the depreciation. We review the vehicle in the home office. There's certain guidelines, how many square foot you can use in the house. Again, I refer you to your accountant on that question. And then what we do is we look at the larger expense items. And this is something where it adds credibility. If your banker calls you and say, hey, this is Steve from the credit union. Hey, we saw some large expenses in here. They look like one time. Can you talk to me about them? So I can do a write up. Because the more upfront you are with them and say, hey, look, even before you give them the package, I had a large expense this year. It's for X, Y, and Z. We don't think it's going to happen again. We just want to let you know what it was. Because if you're disclosing this up front, it's going to make the lender and the banker more your advocate, because you're not trying to hide anything. You're just trying to give them a detailed understanding of how your business works, and that's going to help you get things approved. Okay? Next slide, please. Personal tax returns. They also matter. What we're looking here is, how strong is your personal guarantee? Is the revenue that you're saying on your personal financial statement verifiable via your tax returns? I've seen in some cases people have different amounts when they put on their application versus what's on their tax return. So you want to make sure that you're being accurate and you're looking at it and say, okay, I did make X, Y, and Z, and you can explain that to them. What we're going to look at is, hey, do you have a lot of expenses out there? Are you living within, your means? Do you have an extravagant lifestyle? And what I mean by that is, we'll look at your expenses and say, okay, well, if you've got a $10,000 a month mortgage, that's $120,000 a year you're going to have to do just to pay your mortgage bill. And then we get to the global cash flow analysis. Again, this is money that is coming in from other employment, other income sources. It could be other businesses that we can look at. It could be rental property. It could be money from investments that you have annuitized. There's a lot of different things that could figure into that global cash flow. And the more the cash flow, the better it is, because it just shows us, hey, if we can't get repayment from the business and we can't get it from the collateral, we can get it from the personal guarantee, because this person is making a lot more money than what the debt is outstanding. So it does make things a little bit easier to come across in an approval stage, when we can say, okay, to document this, then, hey, this is something that we can't do normally, but we've got such a strong personal guarantor on the ownership that they've got more than enough to repay us, 2 or 3 times over. It looks like they're living within their means, and, they're personally guaranteeing this loan. So it's just something that a lender can look at and say, okay, if I can't make it work one way, let me see if I can make it work another way. And now, Sam, you want to talk to them about the survey?
Yes, sir. Thank you so much. All right, everybody. Not to take up too much time away from this session, I do want to go ahead and pull up our survey that I did bring up earlier. This is just a satisfaction survey to help us get a better understanding on how today's session went, so that way we can improve future sessions. So I'm going to go ahead and pull it up. It should pop up on your screen shortly, and you guys can go ahead and fill it in. Once it has been filled out, we'll go ahead and continue with the webinar. Should be popping up right now. You guys a few minutes to do so. there.
Sam, could I go ahead and keep going?
Alrighty. Thank you so much. Yes, you can.
Okay, can you get the next slide, please?
Yes, sir.
Okay, so when we're looking at red flags, when we look at tax returns, again, it's the losses year over year. Now, again, if we got a story, it's COVID, it's something that happened. A lot of it's going to go into your story and what you tell the banker up front. You want to be able to articulate and give them a good story about, hey, this is what happened. We don't foresee this going on any further. It will be a red flag, but if you have an explanation that's going to go a longer way than just, you got losses year over year, we're not going to touch the deal. And you just get declined based on cash flow. If we see a lot of deductions that just don't make sense to us, again, you got $30,000 in advertising expenses and you only have $100,000 in total revenue. Help me understand why you spent so much in advertising. If you're a realtor, okay, that makes a little bit more sense. But if you're a construction person or you're in the trades, that's kind of more of a red flag. If there's a lot of depreciation there, this is going to be something also that's a red flag. Okay, well, let's see the schedule of depreciation to see, what's going on in there, because you got a lot of deductions for depreciation. Are you a Turo business? Do you have a fleet of vehicles? What's causing the excess depreciation there? The other is inconsistent income. So let's say that you made, $100,000 one year. Next year you make 20,000. And the next year you make 30,000. Well, that's kind of up and down, up and down. So talk to us about what happened there. Again, it comes to your story. You want to be upfront. You want to have a good story. Just lay all the facts on the line. Is the thing it's going to do is it's going to help the banker be able to say, okay, this is something we can work with right away, or this is something that may need some help with, or this is something we're probably not going to be able to do for you. That way, you're not wasting your time, you're not wasting the lender's time, and you can kind of get a good feeling about looking at your own tax return and saying, if I was a lender, would I lend this person money? Next slide, please. So tax planning versus loan readiness. You minimize your taxes responsibly. You show that you have the ability to repay, and you work with your CPA, and you come up with a strategy that works for you, the CPA, and the lender. I can't tell you, a couple times I've had people that went out and bought a ton of equipment because the accountant told them to, and then we had to put them in workout because their debt service was negative. So that really impacted them for a year trying to get their financials back because they wrote off too many things and they bought too many things. So it's really having a good understanding of working with your banker and say, okay, Mr. or Mrs. Banker, what typically does your underwriter team look at? I'm thinking about buying some things. What do you think will be impact? And, if they know your story, they can advocate for you better. But we can only go with what's on the tax returns at the end of the day. I mean, we can look at projections, but it's really the tax returns that are going to carry weight for us. So, it's very important. Again, the tax season coming up, please, please, please make sure you show as much revenue as possible because it's going to be able to get you that loan or that line of credit approved easier. Next slide, please. Now, let's talk a little bit more about collateral. Collateral is assets pledged to support a loan. It reduces the lender's risk and it's a secondary repayment source. So let's talk about that. So if you have a car that's your collateral for the business. If you have a house, sometimes they'll take that for the business. Similar to what you do with the home equity line of credit, the home is the collateral. It's basically to make sure that if something goes bad, business goes under, or you just can't make the monthly payments, we have a way to be made whole on the lender side. So it reduces our risk. Typically, if there's a collateral shortfall on the business side, they'll look for SBA guarantee. And again, that's something you want to talk to Stuart about, something you want to talk to Jasmine about, because FSC First does a lot of SBA lending, and they're professional about it, and they can really help you learn about what your options are best given your own situation. And again, secondary repayment source. The liquidation of collateral, can come to pay down hopefully most of the loan, if not all of it, and then you would get whatever remains after that. Next slide, please. Common collateral types, again, real estate. Many of you own your own houses. You have a mortgage on your property, you have home equity on your property. The real estate is collateral. Equipment, your heavy equipment, typically you'll have a VIN number. They'll put a UCC filing on the VIN number or the title. That's how they track lien holder interest on that. Vehicles would be with the Motor Vehicles Department for Maryland. They would put a lien on that. And then once you pay it off, you get a lien release and you can get the title in your name. Inventory and accounts receivable, typically they do collateralize that with what's called a UCC filing. And if you're curious, you look at UCC search in Maryland, and it will show you if you have any active UCC filings on your business. So something, to take away today to see, okay, I've dealt with a couple lenders in the past. If you go to a new lender and they see an old UCC filing that hasn't been expired yet, that's something that they're going to probably want you to fix prior to you getting the loan proceeds. Another thing you should do too is look at, making sure that you're in good standing. That's one thing I did not put in this slide deck. If you're not in good standing with the state of Maryland, you will not get a loan approved until you get that good standing updated. Every year you have to file, if you have a S Corp, an LLC, C Corp, any type of corporation, you need to file, in addition to your state return and your federal return, you need to file with the state of Maryland Corporate Division, and you have to file a report there. So please make sure that you do that, because that's one of the things we pull with the loan package. When Jasmine and Stuart or myself, we're looking to put together a loan package, we're going to look and make sure that A, your company is in good standing with the state of Maryland. If it's not, then that's something that's going to cause a problem, no matter what lender you go to. Next slide, please. A sample balance sheet. So this is a snapshot in time. So let's say this is as of December 31st, 2025. You had $25,000 in cash, $40,000 in accounts receivable, you had $20,000 in inventory, and $75,000 in equipment. Your total assets is $160,000. Next slide, please. Liabilities and equity. Accounts payable, $30,000, loans, $65,000, owner's equity, $65,000. Next slide, please. So some myths. Collateral guarantees approval. That is incorrect. Collateral is one piece of the puzzle. The primary pieces of the puzzle are going to be credit score, cash flow, then collateral, and then the other things that you want to get. It definitely helps if you have collateral. Some loans require collateral, whether it be, again, your vehicle, your house, the equipment, the SBA. If you have more assets, is it automatic? Yes. No, it's not. Typically, we want to see, what your credit score is. Do you have a history of repayment? That's going to have a lot more effect than if you have more assets or not. Are those assets liquidable too? If you have art, that's not something that we can easily liquidate. Now, if you went to a private bank or something like that where they specialize in that, that's a different story. But for most lenders, that's what you look at. Next slide, please. So for a strong financial application, loan application, this is typically, what we really like to see, clean financials. So you've got net profit every year on those financials. You have consistent cash flow. So those financials are increasing, on a positive net rate. Collateral, something that makes sense. Clear loan purpose. Now this, again, you want to be as detailed as possible in your loan request. One of the common things I get when people come in and ask me, I just want to see how much I can get. But that doesn't really work on the business side. That's kind of a red flag when you come in and you say that. You really want to say, okay, I need $50,000. I need, to buy some equipment. I need to get payroll. I need to maybe buy a certain type of license or IP. Typically, if the request is over, you're not going to pay it back within 12 months. You really want to term out and make some of that a term loan. Anything you want to revolve, you want to look at a line of credit so you can constantly keep going back, use it, keep going back, use it. But you want to be very, very specific, again, with your story and with the purpose of the lending request. Next. How to prepare before applying. Have updated financials. Separate your expenses, know your numbers, and address weaknesses early. So again, it's telling your story, making sure you disclose all your red flags up front. Be able to talk about your numbers. Instead of just handing people tax returns, oh, my accountant put this together for me. That's kind of like, okay, well, you don't know your own numbers. If you're passionate about your business, you should be able to say, okay, Steve, let me take a look at the numbers. Okay, this is what we did in net profit, year over year, one-time expenses. We're not seeing these expenses in 2026. I'm pretty confident about that. Here's my financials. Here's everything up front. If you've got that loan package already prepared, it's going to really help expedite and to speed up the process, because lenders won't look at things unless they have all the things they requested. I know for us, if we don't have everything that we asked for, we will not start the loan request. So it's really, really important that you look at and say, okay, I need my loan application. I need my personal financial statement. I need 3 years of personal business tax returns. I need a profit and loss and a balance sheet as of a certain date. I need accounts receivable aging. I might need cash flow projections or a business plan, depending on, what the lender is requiring, or if I'm a startup. So there's certain things that might be a little bit different, but those typically are what they're going to ask when they're coming and saying, okay, I have a good loan package. This is really what I want to see. Next slide, please. So I know I talked a lot, and I apologize if I burned through this really quickly, but I wanted to open up for questions. And Sam, if you can moderate for me and ask questions.
Stop sharing. Let me see if there's any questions in the chat right now. Questions in the chat. Anybody want to come off mute and ask a question for Mr. Carpenter?
Yes, this is Sabrina. He mentioned 2 contacts for the SBA